All right. Hello, everyone. Whoop. Hi, everyone, and thank you for attending the final day of Startup Week Boston 2024, the 8th annual week, by the way. My name is Grace, and I'm going to be your host today. Also, a huge thank you to Suffolk University's Sawyer Business School for hosting this conference. They host a lot of great opportunities for learning both in and outside the classrooms, and we really appreciate their partnership for hosting the entirety of Startup Boston Week both last year and this year. I also hear there's some pretty cool students, so, check us out. The goal behind Startup Boston Week is to connect the entire greater Boston and New England startup community. All industries, all startup departments, and all bootstrapped and funding stages for 5 lovely days of continuous learning. The team that creates Startup Boston Week is primarily volunteer, and the folks working the conference here are volunteering their time as well. So if you see someone in a green or red shirt, please say thank you. It goes a long way. So thank you for attending this conference. It is definitely a labor of love, and we appreciate you playing a role in our amazing startup community. Thank you again for attending Startup Boston Week. Now, on to the session.
Hello, I'm Malia. Oh my gosh, thank you. That was for me. I'm Malia Russell. I'm a senior correspondent at Business Insider, where I cover startups and venture capital. And I'm based in New Hampshire, but I tell people I'm from Greater Boston. And sitting on my left is Eric Paley of Founder Collective. Eric has built one of the most resilient and successful firms in seed stage financing with Founder Collective. He led the firm's early investments in small startups before they became breakout hits, such as Uber, ever heard of it? Airtable, The Trade Desk, and Boston's own Whoop. And he has been named 5 times to the Forbes Midas list of top venture capitalists, which is a rare feat for such early stage investors. And the funny thing about Eric, I think, is that if you read enough of his tweets or writing, as I have, you start to think that maybe he's trying to put himself out of a job. And I say that because Eric is a stalwart supporter of efficient entrepreneurship. He warns founders against the dangers of raising too much capital. He uses phrases like toxic substance and overdosing on VC to the point where his firm actually sends stickers to new portfolio companies with messages like burn responsibly. So I was going to ask, why do you hate VC? But I'm not going to ask that. I think just for some table setting, Eric, break down for us, what is the conventional wisdom on fundraising and what do you think it gets wrong?
Well, first of all, thanks everyone for having me. I'm delighted to be here. I'm very grateful Malia chose to do this today. She's a phenomenal reporter and a total pro, and I'm going to get some hard questions as a result, which is totally fine. So conventional wisdom and venture capital. So start with, our country is built by entrepreneurs, small business entrepreneurs and rocket ship entrepreneurs who do extraordinary things. I'm very proud to be part of that ecosystem. So why do I hate VC? I don't hate VC, but I think VC is very full of itself, and there's what someone else in our industry is now calling the venture capital industrial complex, right? Where the mic's going in and out, but where the VC train, the machine, the sort of orthodoxy of venture capital, has a recipe, a track for everyone who ends up on it. Most entrepreneurs, it's so hard to build a company that most entrepreneurs start from the standpoint of, if I could just find a way to get some money, that'd be amazing. And that's totally legit, right? Whether it's $50,000 or $500,000, whether it's a loan or equity, friends or family, these are amazing things that make it possible in most cases to start businesses. So that's where you start. And you start thinking about, wow, this is amazing. There's this whole industry of people whose job it is to give money to people like me, hopefully, right? And that's very exciting. What gets lost in the whole thing is venture capital is a finance industry. It's not really a startup industry for most venture capitalists. Most people who do venture capital never ran startups. They've never been in your shoes. They don't understand how hard the job is. It's a little bit like sitting in the front row at a baseball game wondering why a great hitter struck out and thinking you could do that better, right? And so most of these folks come out of finance. And the goal for most venture capitalists is to have maximum assets under management. That's pretty much the goal for every single person in the financial services industry. You'd think the goal would be to have the greatest returns. Maybe long-term on some level, of course it is, because that allows them to take home some profit sharing. But at a minimum, the more money they have under management, one, there's ego rights associated with it, but primarily there's income related to that. Because that's the game of venture capital, the second a VC has put money into your company, their primary goal is to figure out how to get more money into your company. Maybe not from them, but from somebody, right? If your company's going well, they're going to try to pile money in and potentially go elsewhere. If their company's not doing well, they're going to try to find that money elsewhere. But what they're playing for more than anything is short-term markups, right? That's how they measure their success. The problem with that, it actually all sounds not so terrible, right? It's like you get more and more money. That's fantastic. You become a lottery ticket to that venture capitalist. I don't think most entrepreneurs want to be a lottery ticket, right? When the lottery's over and the ticket is not a winning ticket, what does somebody who owns a lottery ticket do with the ticket? They throw it in the trash. That's what the venture capital industry mostly does to startups. It's let 1,000 flowers bloom. That doesn't sound so bad. Find out which one actually is really the winner and let the other 999 die, right? And so the problem becomes, instead of actually using capital to build muscle that really drives long-term sustainable intrinsic value in the business you're creating, they're basically putting you on this steroid fix that if you cannot constantly live up to it, sorry, we'll move on to another company. It's not my problem. So the grotesque analogy I use, which is pretty harsh, is we're an industry of people, hopefully I'm not included in this, who is injecting steroids into babies hoping they become Olympians. And the rest of the babies, well, who cares what the steroids do to those babies? It's not a problem for us, right? That's a problem for somebody else. But the one that becomes Olympian, well, that was a great bet because there's asymmetric outcomes and it allows me to raise more and more money and get more and more markups and tell my story. And hopefully that makes the VC rich. So we've dedicated ourselves at Founder Collective to alignment to the entrepreneur. That's our North Star. And that means that, sure, we can be incredibly ambitious. You can't build great companies without being incredibly ambitious. But our ambition is not disconnected from the reality of actually building that business. To become $1 billion business, you have to be $1 million business first. You have to be a $10 million business, $100 million. You actually have to build the business. And VCs tend to lose track of that, except when you ask them for more money and they're not sure the business is going well enough, right? Which is a whole nother dynamic that we can talk about. But anyway, that's my quick introduction to VC's a hell of a drug. And just to add one more thing, there's an empirical side to this too, which is fascinating. We did an analysis of the IPOs, the most successful IPOs in venture capital over a period of time. And there was no correlation between raising the most money among those companies and having the best outcomes, which may sound like, okay, so there's no correlation, but it's actually fascinating to really think about, because you'd say, okay, maybe you could show there's no causality, right? Maybe the extra money doesn't help it become a better company. But the fact that it's not even correlated, when you'd think the best companies, of course, can raise the most money, right? So like you think about, like, by itself, even if it wasn't causal, the best companies should be in the position to raise the most money. They have a huge unfair advantage in raising the most money. So there should be correlation there. And there actually wasn't even correlation in the two. So very much worth thinking about as an entrepreneur.
So you've spelled out that the VCs would like their founders to raise more money because it gives them the markup so the VCs can go raise more money from LPs. What is the founder doing with that capital they raise that raises some red flags for you?
Yeah, so somebody tweeted the other day that one of their portfolio companies, or a whole lot of companies right now, are proudly saying to their venture capitalists that they have 72 months of capital on the books. I have not seen very many companies do that, but I've seen a few over time. Actually, Airtable comes to mind as a very valuable company that in the early days literally would send out these updates that said, oh, we have 55 months of capital. By the way, if you don't know, what's typical is somewhere between 12 and 24 months. But the point is that, what does that mean? It means they're not burning the money. Right? They're holding the money and not burning it. And this person was critical of that, as most VCs would be. Like, we didn't give you the money for it to be sitting in your bank account. We'd rather be sitting in our bank account. You should be growing your business with it. So this person was critical, and I said, boy, do we see that differently. And the reason we see that differently is if the industry is pushing money on you as an entrepreneur, and you decide to take that money, we could have a debate about whether it's good or not to take it. but you decide to take that money. I actually think the most logical thing to do with it, until you have found places to put it that really work, that are efficient in terms of turbocharging your business, machines that you can invest in where you put $1 in and you get $2 out consistently up until the point of diminishing returns, but you keep pushing that while you're net profitable on that transaction. But if you don't have that, which most startups don't, very few startups, believe it or not, have that machine. We could talk about what I mean by that in more detail. But if you don't have that machine, you should just be buying yourself time, right? And you shouldn't be spending the money before you have that machine. So you need to spend some money to keep the lights on and keep the business going and experiment. But experiments are really cheap, right? Most of the venture dollars don't go to experimentation. They go to scaling, go to market, right? And that may be different if you're in deep tech or biotech. I'm really talking about general infotech. But most of the dollars go to scaling, go to market. And investing in a scaling machine that is not returning for you and scaling it up more and more because you have huge pressure from venture capitalists that you should live up to a valuation and raise more money, I think that's a fool's errand that creates irreparable harm for startups. So again, for a lot of you who might just be starting out, you're like, all sounds like really good problems. But the main thing I want to get across, even to folks who are just starting out, and you're right, it all sounds like really good problems relative to I need money and I'm having trouble finding it, is at some point, for you, if you're going to raise money, you're going to start becoming attractive to capital, whether that's for a very short period of time or a long period of time. And people say like raising money is like getting term sheets is like getting pickles out of a jar. The first one's really tough and then it gets really easy. But like once you become interesting to people, you become interesting to a lot of people. And it's like, how do you create that moment? And then once you do, how do you start making choices that are disciplined, both in how much you raise, because that creates huge pressure in terms of what you need to live up to and how you're going to burn that money, and just how you burn it, right? Which is the other vector you have control over as the entrepreneur. And you shouldn't let your VC's desire for markups drive irrational investment. But we can talk more and more why this happens, but the pressure to do it, it's not like a VC's yelling at you. It's partially because for the first time for most entrepreneurs, and I felt this too, you start to feel like you're not delusional. You're like, wow, like I've had this dream and everyone's told me I'm wrong and I've been working on it and I believe in it and all these people think I'm wrong. And then all of a sudden, a whole lot of people think I'm right. And they're giving me money and they're saying, you can do this, go faster, go faster, go faster. And you're the only, I say this all the time at Founder Collective, but you're the only grown-up in the room. The VCs, they're not grown-ups. They may look older, maybe, but they're not the grown-ups. They don't care about your downside. They don't care about that you might need more time to get there. All they care about is, are you a rocket ship or not? Are you a winning lottery ticket? And the second you're not, it's not their problem, right? And so you've got to be the grown-up, because that's not a very grown-up way of thinking about things, in my opinion.
I wanted to briefly touch on bootstrapping. I think we have a strong tradition of that here in Boston. And I'm actually going to read a quote back to you from something you wrote in 2016.
Hopefully it wasn't too dumb.
Well, the essay was called "Venture Capital is a Hell of a Drug," which now sounds like a Taylor Swift song to me. You wrote, "Founders need to think of venture capital as a power tool, a fairly dangerous one, but instead mistake it for some magical infinitely renewable resource. In the right hands, power tools can solve some real problems. Used correctly, they can chop off your hands." And I love this.
Hopefully used incorrectly, but I don't know how I wrote it. I might. Yeah.
And used incorrectly.
Yeah, okay,
Thank
good.
you. They can chop off your hands. Thank you for correcting me. And my takeaway from reading that is that it's not that you're taking a just say no position to capital, right? Like, can you spell out for me, are you a fan of bootstrapping?
Yeah. So, yes and no. So there's two discussions I get into with people when they hear my philosophy on this that I think are misunderstanding what I'm talking about, right? One is they're like, yes, every company should be profitable. Well, there's a discipline in profitability, and there's actually quite an intellectual laziness in profitability. And that's kind of confusing to people. But I think the intellectual laziness in profitability is if you have your business throwing off cash and you have lots of great insights of where you could be investing to drive the growth of your business, why are you throwing off cash, right? At some point, you should be investing. Like, I think if you're ambitious, You should be reinvesting in your business. No problem if you have a family business and you use this for your family to live on, and like you fourth generation and there's 25 family members living. Sure, throw off cash all you want. But I think if you're ambitious and you're trying to build something great in the world, you should be investing in it. So I would say like the Bezos model, which maybe not everyone's familiar with, but like people criticized. He wasn't profitable for like 20 years, but he ran pretty close to break even for most of those years. And he was just aggressively investing in his business. And if you can invest in your business and create positive intrinsic value in your business over and over and over again, you should do that. The problem with throwing off cash is it doesn't actually compound any value. It's great. People might like that you throw off cash, but you're not compounding value. So I wrote this piece, like 2 laws of startup physics, right? The 2 laws are this. Capital compounds whatever you have. If you have a positive value formula that you're investing in, it can compound incredible value. If you have a negative value formula, which I would say 90% of venture capital-backed businesses have negative value formulas, you are compounding negative. I don't know how many people have looked closely at compounding tables on the negative side, but they go to zero, they don't quite go to zero, but they move towards zero very, very, very quickly. And so all of a sudden you see these companies where it's like big layoff one day, and maybe some people in this room have been affected by this. How did this all happen in one day? It didn't happen in one day. It happened over years of compounding negative value. Just that was the day everyone finally admitted what happened. But it was happening the whole time, right? Nobody just wanted to say it out loud, but nobody wanted to give them more money. Why? Well, they were compounding negative value for years and years, and you're like, wow, this company raised $100 million. How am I getting laid off today? Well, it raised it 2 years ago. It burned it really stupidly. It compounded to zero. So, okay, law 1, capital compounds what you have. So if you don't have a positive value formula, don't compound it. Fix it, right? Law 2 is everything you're compounding has a diminishing return. So I think in business, are there people here who are at business school right now? How many people are at business school? We got a couple. How many people have a business degree? Okay, so in business we learn as you grow, there are economies of scale. I think that is an industrial idea. I don't think that is an information age idea. I think as you grow, there are diseconomies of scale in almost every startup I've ever seen. And I can give you examples of that hopefully are helpful. Let's say there's a product you love. You get a new release of that. Product's been around for a while. You get a new release of that product. Every once in a while, the new release of that product might be like amazing or game-changing or like really make a difference for you. Most of the time, it's an incremental value that's less than the last iteration of the product. So think of your iPhone. Maybe with Apple Intelligence now, there's going to be a new step function. But for years, I would say each iteration has been a diminishing return of value to the customer, right? Not because Apple's a bad company, they're doing a great job. But it is hard when you've created a great product to keep making it like materially better and better and better. So that's a diminishing return curve. Anyone who's ever bought media or marketing, if you've ever led marketing, you have a marketing budget. Where do you invest it first? Well, in the low-hanging fruit, right? Over time, you run out of low-hanging fruit. You need to go to higher-hanging fruit in terms of your investments. It's less efficient. It's more expensive. It's a diminishing return curve. If you're hiring salespeople, the bigger your sales force gets, usually the less productive that sales organization gets. It's a diminishing return curve. Almost everything in the startup world, every engine that works, that creates value, has a diminishing return curve to it. So I used to wonder about this. I'd be like, well, geez, I went to business school and I learned about economies of scale. And so if you're a startup and you grow 100% last year, why did you only grow 40% this year or whatever, and on and on and on down? What's exactly happening? People would say, oh, it gets harder as you get bigger. But then they'd deny that there was this real effect. I mean, they were kind of describing it, but broadly, we don't talk about it this way. And so now you've got to deal with the fact that you're compounding something, but whatever you're compounding is going to hit a diminishing return curve. And most startups cannot deal with that because they've got to go get that higher valuation. They've got to raise them more money. They've got to tell their boards how awesome it is. They want their management team to believe and not to leave the company. And everyone's finally drinking the Kool-Aid that inspired you to do this in the first place. And everyone's ambitious and excited. And so, it's like you go on a run at the casino and you're doing really awesome. You're convinced you're really good, but it's a casino. You're just lucky, right? Or maybe you are really good, but the pressure of that diminishing return curve is such that you're going to go negative at some point. Well, how do you avoid that? Experimentation. What is experimentation? Expensive or cheap? It should be pretty cheap, right? You see people say crazy things about experimentation all the time. They say, we need this experiment to work, so we're just going to launch it at scale. The fact that you need something to work has nothing to do with whether or not it works. Those two things have nothing to do with each other, right? Like, I need to be able to fly does not mean I can jump off a building and fly, right? Like, I still need to construct a plane that works if I want to fly, right? And startups do this. Startup boards are unbelievably irresponsible because, again, we understand the incentives now of VCs. And they say things like this all the time. Well, we're never going to hit our number unless we invest in X, Y, and Z aggressively. So we're just going to do that. And they don't say, well, have we done anything to validate X, Y, and Z? And they're like, seems like a good hunch. We're never going to make it unless we do that. We're going to miss our number. So we got to do that. It doesn't work because you want it to work. That's never why it works, right? It works because you validated, tested, validated, and it works. And usually, in most cases, unless you have to like build a huge plant or something, it's not that expensive to test. Sorry, that's a very long answer.
No. You talk in this tweet storm about how if a model is working and you're pouring gasoline on it, great. But most of the time, or more often than not, founders are using capital to find that model that works. They're saying, I need this to work. So
or even to pretend that it's working, because it can be confusing whether or not it's working, right? Like you're like, well, okay, I need each sales rep to produce $500,000 a year in revenue for net of my margin cost and my sales rep costs and my marketing costs. Otherwise, I'm losing money. But I'm at like 380. I'm sure we'll figure out how to get there, right? Like we can double the sales force on the assumption we're going to get there. And of course, what do we talk about? Diminishing return curves. So like your 380 is going to become 300. It's going to go down. It's not going to go up. Right? So you don't fix things as you scale them. It actually gets harder as you scale them, right? And so you have to think about it that way.
Can you explain to me, how do I validate that my model, that my economic engine is working? And is growth the number I should be looking at, or are there better metrics to assess that?
So I have a terrific Israeli company where the CEO has been very disciplined, and it took him 5 years to get to $1 million in sales. So had he overcapitalized the company, I think he would have overburned, gone out of business. But instead, he kept the burn low. And anyway, but now it's $1 billion company. He's built a great company. But he called me a few years ago, and he said, I'm burning about $200,000 a month. I have $10 million in the bank. And we're doing so well now that somebody's offering me $30 million. What do you think I should, at a good valuation, what do you think I should do? And I said, well, why don't you start trying to figure out how to spend $300,000 a month intelligently and make sure you're getting the results that really justify that spend, and then 4, and then 5, and then 7, and then 9. But what do you need $30 million for if you can't figure out how to intelligently spend $400,000 a month? You'll have money for the rest of your life. And that sounds good again, but that's not the expectation of your investors. That you have not aligned yourself to the people investing in your company, right? So they don't want to see you sit on $40 million. Yeah. And so what do you need the money for? And why even bother, even if it's a good deal, why bother taking dilution, right? And we could talk about what dilution really is, because that, I think, is radically misunderstood in our industry. And it plays into a lot of this. The misunderstanding leads to a lot of these problems. But I think the answer to your question is like, how do you show, and this is where like a good CFO can be very powerful, because sometimes it starts getting a little hypothetical, and somebody who's really good at working through the numbers can help build confidence that you're making really smart investments. But how do you show what the return on investment really is of the incremental capital, right? And sometimes you can't completely know, and sometimes intrinsic value in your business is more abstract than putting $1 in and taking $2 out. Often it is. So I don't want to minimize the complexity of all that. The number of companies I've had that said basically we're investing in a data asset and we're going to scale our investment like crazy in that data asset, only to sell the business for like nothing, because it turned out their data asset was just not actually something that mattered to anyone in the market. It's a very dangerous way. I'm not saying it could never be true, but it's a very dangerous way of thinking. We're investing in IP. People radically outside of climate, I want to say hard tech and biotech, but in my world, people radically overvalue the notion of intellectual property, radically. Like it is, IP is like a proxy war that actually has very little to do with real value. Like every time you hear them on Shark Tank talk about patents, it's because they don't understand what they're talking about.
Mark Cuban is actually here in the room. Yeah.
Well, Mark might agree with me. I don't know. It's usually Kevin who's kind of out of his mind anyway and doesn't know it. Like thinks taking royalties out of young businesses is somehow a good idea. It's a crazy idea. Like let's strip mine the business of its ability to invest in itself.
I think a great event for next year's Startup Boston Week would be like a viewing party of Shark Tank where we get like a panel.
Do I get to pan them the whole time? If I get to pan them the whole time, I'm in. But they're much more famous, and that's good for them. And that's what most VCs want to be, which is why assets under management, blah, 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 go on and on.
All right. So I have one more question on this, and then we're going to move to kind of some advice you have for people in the audience about, okay, how do I get that bag? I'll worry later about how to shepherd it responsibly. But I did want to ask, you talked about how the VCs are not your grown-ups. The founder is the adult in the room. But these rules around efficient entrepreneurship sound really hard to follow. I have the VCs telling me to grow faster, spend that dough. So I'm curious, what advice do you give to the founder? Do they need an accountability team? How do they learn to say no?
I would start with really do your homework on the investor and really have candid conversations that don't give up on the air game of how exciting and big where you want to go is, but has very practical, real discussions about what the ground game is going to be of getting there, and how they think about that. And you want to work with people this is why we've made alignment our North Star as Founder Collective, right? Our mission statement is to be the most aligned fund to founders at the seed stage. You should be looking for hopefully we live up to that. You can go do the research on that. But however you do it, not about us, whoever you're taking money from, you want to make sure, first of all, they're very aligned to what you want to do in your business. You don't want to, of course, you got to sell them the big picture, but you don't want to sell them the ground game that is misaligned with what you think you're really ready to do, right? Secondarily, this is where real finance help can because look, we're all dreaming big. The point is to be ambitious. But I say the great entrepreneurs have their eyes to the sky, but their feet planted firmly on the ground. If you lose contact with the real world, you will fail. So you've got to stay in contact with the real world to succeed, right? And that's also why you want to stop dreaming of what everything's going to be and get testing in front of your customers as quickly as you possibly can to figure out, do they care? How do I know they care? The idea is not what matters. What your customer cares about is what matters, right? What you think they care about matters less than what they actually care about, right? But this is where somebody very good on the finance side, if it's not your strength, is very valuable, because actually understanding what the return on investment is for you of the dollars you're investing intelligently is very powerful. It's very hard to figure that out, let's just say, just to be clear, for your engineering team, right? A new product feature comes out, and yes, in theory, if it helps sell, you could somehow measure. But the scale-up team, the marketing, the sales, the customer success, that's where the big dollars ultimately go to over time. And that's all measurable. And yet people create fantasies of what's actually happening in their business, and they build those fantasies with their boards, and they dilute their business to zero over time. And that is the sad story of most of venture capital. I mean, we tell the very most exciting stories, the Ubers, or maybe right now it's OpenAI. But even OpenAI, it's a super interesting question whether fundraising at $150 million at this stage of their business is good or bad. It sounds really exciting. But and they do need a lot of capital for a lot of reasons, but actually it could be the reason they fail. We say post product market fit, the number one reason startups fail once you've gotten product market fit is bad capitalization. You don't use money well, right? You use money in a way that doesn't get you the results it needs for you to continue to invest correctly, and therefore you compound the value of the business to zero, even though probably it should have had real value.
I just want to note that we are going to open this up to Q&A in the last 15 minutes. So if you have a question for Eric, start thinking on that. And like I said a minute ago, we've been talking a lot about how to burn responsibly, but it's not lost on me that that's not the problem facing most founders right now. There's a lot less money sloshing around the ecosystem. There is a bifurcation of haves and have-nots in Boston, New York, and Silicon Valley right now. So you being a pre-seed and seed investor, would love to hear what advice you have for someone who's just looking to raise their first $1 million. Where do they get started?
Yep. So let me try to relate some of this, hopefully, to just getting started, because I recognize you start talking about too much capital, and most people are like, I just need some money. So it's, in my mind, it's about substance. right? The discussion of scale up is about, am I investing in intrinsic value creation and substance that will long-term compound value for me or not? I think when you're starting your business, it's literally the exact same question in a different way. So it's not about, obviously, burn rates. But what can you do to start validating what you have? Even if you are the worst salesperson in the entire world, and you're in a category that VCs have terrible bias against, whether by industry or by much more like insidious, upsetting forms of bias, any of those things, you start proving your business works, it gets very hard for people not to take it very seriously and start to get interested in investing. So the key point is start with, what do you need to prove to yourself to commit the next 7 to 10 years of your life to this? And it can't be that you're building this business because you think you have a brilliant idea. That's fine. It can be a starting catalyst. But you need to actually get to a point of informed pessimism about your business. And when I say informed pessimism, I don't mean like you're pessimistic, you absolutely believe it can't work. But what I mean is you've engaged the really, really hard parts. Every business, there are reasons why it's hard to believe it's going to work. Like, I used to have a chip on my shoulder when I got rejected by VCs. I hated them, and hate's a little hard, but I resented them, and I just thought they were idiots and they were wrong. There were a million reasons, but I would also say I did much of this work quite well. But in truth, there were a million reasons why my business wasn't going to work. And my job, and this is the thing I was actually not so bad at, and it's why I got venture capitalists to invest in a terrible time in the market into a sector that they absolutely hated, was digging really, really deep in what were those really hard parts and how are we going to overcome them. So the entrepreneurs who impress us, we say they impress us because they're all over it, right? They're all over the hard parts, and they love talking about the hard parts. I would say most entrepreneurs don't love talking about the hard parts. They want to hand wave through the hard parts. You know, it's the old interview answer when they say, well, tell me about some of your weaknesses, and you say, well, I work too hard. You know, like, they want to wave their hands at the hard parts. They don't want to have a candid conversation about it. And the reason why I work too hard maybe works in an interview is, you kind of usually get away without actually admitting what your weaknesses are in an interview. But it's more objective on some level when you're analyzing a business. It's not objective that we know the answer, but it's more objective in that somebody can just stop on, I'm just worried the market's not big enough. And that's it. It's over. So if you haven't, it's a dumb little example because it's one of the hardest ones to prove, but at least if you haven't done the work to try to figure out how to best validate that this is a venture scale business, which by the way, many, many businesses aren't, it doesn't make them bad businesses, but you don't want venture capital in a non-venture scale business. It's like putting rocket fuel in a Ferrari. You're going to destroy a really nice car. But you have to not just prepare yourself for that question. You got to figure out how to do the work. Usually it's much more about, the channels in this business seem really locked up. I don't know how you get to the customer. And the entrepreneur will literally find some way to say something that effectively boils down to, but everyone wants this. It won't be a problem. It's kind of, I used to have this thing back in the early 2010s. There was so much talk about things going viral. And the entrepreneurs would say, we're gonna engineer it to go viral. And I'd say, why not just engineer it to go lucky? You just basically said the same thing, but like they don't want to, I was like, okay, tell me about that. How do you engineer it to go viral? And then people would give these really generic answers about like memes and things that go viral. And I'm like, okay, but there are a lot of people out there trying to generate the thing that goes viral. Why is this going to go viral? And some people would get very defensive or they just continue to throw out very glib answers. So anyway, my best answer to you is don't invest the next 7 to 10 years in your life unless you're seriously grinding down to do the hard work to figure out like what does the customer care about, how are we going to make this work, and engage the really hard parts of your business. I think many entrepreneurs do that and then aren't willing to engage it with the VC. So do that work, and then I think don't be shy to engage it with the VC, because I think that's the substance, and that's the same thing. Like you invest more capital more aggressively in your business because substantively you're proving value. Yeah. So I think it echoes, right? When you're always just trying to do wave hands and tell big stories, then you keep funneling money into your company in really dumb ways, and you ultimately run to zero. And the number of companies that fail by hubris is pretty extraordinary.
Does someone need a warm intro to get through to you?
You need a warm intro. Now, I'd like to say you don't, in the sense that we actually look at every single deck that comes into our cold channel, and we have funded cold privileges. So do you need one? I guess there's some level in which you don't. Are we way more likely to miss you as an entrepreneur if you send in a deck? By the way, what's amazing is people send us like, I'm starting a company. It's in the fintech space. I can't tell you much about it, but if you're interested, I'm sending you an NDA. This is somebody we don't even know. And so we just write back, if you'd like to send us a deck, we'd be happy to look at it. And they'll write back about an NDA and we'll never respond again. So I think understand that almost every good, hopefully we're good, but I can speak about a category of VCs who are considered good venture capitalists, who are good to work with. They're inundated with a lot of opportunities. If you want, and it's very hard to derive signal about an opportunity just by looking even at a deck, because it's not about the idea, right? It's about the person and the work they're going to do. And I can't know anything about you really but your resume, and we all have lived through resumes being very misleading. I don't mean false resumes. I mean like good resumes, but actually then you start working with the person, you're like, it's amazing you have all this on your resume, but like you don't know how to do most of the stuff I need you to do. So okay, a resume is something, but if your resume doesn't obviously stand out like crazy, which most people's, it's not, most of the people we back, their resume doesn't stand out in a way that's like, oh my God, we have to meet this person. How would we know anything about you that would make us interested? And we're really investing in a person and a team, but ultimately, first and foremost, a person. How would we know anything about you? So the best way you can get to us is by having someone that we trust, and there's a little bit of work to do to figure out who do we trust, but it is possible. Say, oh, this is a phenomenal person, right? You should meet this person. I think this is a great entrepreneur. That is the best way you can get in the door at any venture capitalist. So I do believe it matters. Now you might say that's a very discriminatory way to make judgments. And I'm going to say it's actually one of the things that makes me most uncomfortable about venture capital. And yet, at the end of the day, we are investing first and foremost in people. And the good news for the people we invest in is they know when we've invested, we really invested in them. We didn't invest with a hope that we like their idea and we're going to get rid of them. We invested in them. But because we're really investing in people, we are trying to figure out the fastest way we can how to prioritize all of the opportunities we get to spend time, largely based on what we can learn about people. So I would say, put your best foot forward, network your way, maybe not to us, but to whoever you want to work with, and find the best way to get to those people. And by the way, we live this because we do a tremendous amount of work helping our companies raise money for the next round. And we will advise them about how to approach all these other VCs. We never tell them to approach cold, ever. We consider ourselves a good, not great intro. A great intro is an entrepreneur that made them a lot of money. And so we say, hey, do you know Brian Halligan? Because Brian Halligan made Sequoia a lot of money. It looks like you know him, and he thinks highly of you. Maybe you worked for him or something. He's a better intro to Sequoia right now than we know all those guys well. We've been on boards with those guys, but they know we're an investor in your company already. And we didn't make them money. He made them money. So there is a hierarchy to this, and it is about being sophisticated, right, about how to get to people. And I think it forces, unfortunately, people to have to really get good at networking, because not every brilliant entrepreneur is good at networking. But one of the things you got to do is build your tribe early, right? Start networking to the people who should care about what you're doing because they've done something related to it, or they know you and they think really highly of you. But think of the most credible people you know who believe in you. It might be your professor, or a professor used to have. It might be a friend who was an entrepreneur. It might be somebody who you barely know, but they know your space really well, and like they should be interested because what you're doing is so game changing in that space. And you find your way to them, and this is how you start building that tribe. And like we had an extraordinary amount of advantage. We were incredibly privileged when we built Brontes in terms of who we had network access to, but we did a crazy amount of work building the tribe. Like I can give lots of stories about it. I don't want to keep going too deep, but yeah.
I was going to ask, you are an unabashedly sector agnostic investor, right? And something I've been hearing from VCs recently is that if you are not an AI company, be aware that every VC right now, maybe not you, is bending and weaving to find the next OpenAI. And that a smart move for founders right now is to find the like thematic investors or ones that are like focused on a really specific category. Like, so I don't want to like throw you under the bus, but is that advice you would give founders?
Well, for sure, if there are investors who specialize in your category, you want to talk to those investors. They're going to understand it better, and it doesn't mean you never go to anyone generalist. So that's like a mission against interest. But obviously, you're trying to find capital, and the people who understand what you're doing or looking for companies like yours are the most likely. What I will tell you if you're in the AI sector is there's good news and there's bad news. The good news is, yes, VCs are like overpaying. They're paying a lot more than for other companies, and they're very interested in AI. The bad news is we now 50% of what we receive as deal flow as a generalist VC has an AI part to the pitch. We just looked at this analysis, just about 50%. So everything has AI. And by the way, just an aside, I think everything will have AI in software, right? Because I have a personal view, not just because AI is important and whatnot. I would argue in some ways it's more important than people think. In other ways, it's way less important than people think from my viewpoint. But the way I think it's unbelievably important is even back in 2003 when we started Brontes, which is the company I started before Founder Collective that we sold to 3M, there was no one I knew who wasn't building some part of their stack on open source. There were componentry out there that you were going to layer in. Like when I built my first company, Abstract Edge, we were a web development company for startups. And we had to build registration flows for anyone to register for a website. We had to build credit card processing. We had to build like every stupid module that made no sense that anyone that you would build customer by customer by customer. Those all got replaced with open source modules that you could use for everything. Well, AI is the next powerful generation of software, right? We can talk about it as many other things, but that's a big part of what it is. And the open source part of AI, I think, is going to be very powerful. And so everyone's going to be building on AI, and it's going to start to sound a little silly, like saying like you're a .com sounds a little silly now. At some point, it's going to sound a little silly unless you have some like really novel base AI technology or some new user. It's like when I started Founder Collective, saying you're a mobile startup or a mobile first startup was a really big deal. I don't think a lot of people talk about things like that anymore. But it wasn't so much the core technology of mobile that a lot of people at the time were looking for that turned out to be the great startups. We can use Uber as an example. It was application use of that technology that created one of the great startups in that time. I think there's going to be a lot of opportunity like that with AI. And so you can talk about why does AI change the game and enable something that it never did before. But I just want, I think every tech startup is going to be an AI startup. On some level, and that's what we're seeing at this point.
Yeah. 5 minutes. All right. I'll open it up to some Q&A. I feel like we have very engaged listeners today. And we have a mic runner, right, Grace? Yeah, someone in a green shirt will bring you a mic. Here we go.
Hi, thank you for this incredibly refreshing. I'm Chris. I'm the VP of Growth at a portfolio company owned by Vista, someone you might have an opinion on.
They've bought 5 of our companies.
So it's, okay, got it.
So I have a lot of opinions, but I also appreciate the liquidity.
Are you safe? Blink twice.
Yeah.
Question is, how do your investors feel about your perception of the traditional venture model, and is it different? Are the outcomes different for them, or do they appreciate your view versus other investments they make?
So our most mature fund, Founder Collective One, is one of the most high-performing funds of its generation, maybe of like the history of venture capital. I don't mean like top 5, but probably.
Eric wrote a $95,000 check into Uber in 2010.
Yeah, and actually the Trade Desk was an even better investment than Uber, which most people don't know the company, but it's the leading company for the open web for powering advertising. So they compete with Google and with Facebook, and those are their peers on that level. It's a $50 billion public company. So I think start with LPs like when you send them checks, and we've sent them a lot of checks. And our subsequent funds are doing really, really nicely as well. I think they appreciate a different approach. And the thing is, you also have to live by this approach. The challenge for us is, AUM is convenient. It's nice to pay yourself a high salary. And we're on Fund 5, and we are the only well-branded, well-known seed fund that has stayed anywhere close to as small as we have. There's no one else. The next closest is 50% bigger than we are. So that means we have fewer resources, we pay ourselves less money. You have to live by those things, right? And so I think they appreciate that we do that. So the challenge with all of our LPs is they're like, we want to write bigger checks into you guys, but we don't want anyone else to, right? We want you to stay small and true to what you're doing, but we'd like to write a bigger check. But I think that's a good problem to have. And so it's worked out fine. Yeah, I think very well. So. And I think they like that people are calling out a lot of the nonsense in the industry. I do. Yeah.
Hi, thanks for sharing these insights for funders, especially for us first-time funders. I actually want to know from investor perspective, right? What do you think those early stage funders, pre-seed funders, the top 1 or 2 things you see, they are ready to for seed or the next round?
Sorry, so you're asking when
as an investor, right? Or what top 1 or 2 things you think you will look at this startup or the funders are ready to.
The founders are ready.
Yes.
So you're saying when we have a company, how do we get to the point where we say, oh yeah, you should be raising more money from someone else? Because we never lead a next round, so we have to help them find the next round, right? And because it creates a conflict this is part of the alignment thing we could talk about. But when do we decide that? Well, there's 2 realities. I want to first acknowledge just the reality of what we do for a living, right? Which is companies start running out of money and they have 6 months or less of capital. And we've got to have a hard conversation about how they're going to keep their company alive. And there are situations like that where they're going to need more money. And usually then we'll talk about, can we add some other small funds? That's when they haven't hit metrics that we think are really exciting for justifying a bigger round. When they hit those metrics, we will start to show it to whom we think are the best investors for that company. And with the entrepreneur, we never go around the entrepreneur on this, but we'll work with the entrepreneur to figure out who that is and how to help make sure we're telling the story in the best possible way. But really that's driven by this is such a simple thing, but it's not what happens in our industry. You want to raise money because things are working, not constantly be raising money to figure out what could work. So yeah, you're at the beginning, you're going to need to raise some money to figure out what could work. But you don't want to try to raise a Series A when nothing's really working, telling people but the dream, I'm going to tell you about the dream, because you're always going to be selling this dream over and over again, and you're always going to be selling ahead of what the substance you've built. And that puts you on this track that creates this irreparable harm that makes it almost impossible to succeed. But we love when our companies, in our opinion, for their stage, are succeeding. And it's very clear that if you scale up that investment, it's pretty exciting what's going to happen. So yeah, that's what we look for.
Yes, I just wondered, how do you feel about hedge funds?
Well, there's 2 versions of this. One is I'm a capitalist, right? And so I want to acknowledge that, on some level, and I always was modestly uncomfortable with this, but I think there's truth in it. We need to have constant liquidity in our markets for them to work. So somebody has to be constantly arbitraging the market to make sure there's efficiency. Ultimately, all those arbitrages close and there's efficiency in the market, right? So you get away from these if there was a really good way, and maybe there is more than I understand, for hedge funds to be engaged in the housing market, we wouldn't have this strange situation right now with extraordinary lack of supply in the housing market. Right? So maybe, or maybe they'd corrupt it so badly. So this is the other side. So one part of the answer is on an economics level, I begrudgingly understand the value of hedge funds in the world. On a soulful level of somebody who is all about building stuff, financial engineering makes me crazy. And I really find it, so I want there to be liquid markets. So I have to accept that, but I want people to be builders. I want people to be focused on creating value for people in the world, not just engineering finance. And I think usually when you get caught up in engineering finance, you start to do things that actually, in many cases, are not so great for society. So I have quite the begrudging view of hedge funds, but I also acknowledge their value. I have quite the begrudging view of the stock market, right, where this obsession with quarter to quarter, but I also see an enormous importance in us having a robust and healthy stock market. So it's a two-sided coin. I don't know if the question was getting at sort of that kind of answer, but that's how I kind of think about that world. No, we can chat afterwards. It was not a sufficient answer. Yeah.
Hi, Eric. Great presentation, and thank you. My question is, what is your opinion about experienced founders versus non-experienced?
Yeah. So it's very interesting. The venture capital industry has forever chased validated, experienced founders. The entire time I was running Brontes, my board of directors was trying to figure out the right time to replace me. As soon as I sold the company to 3M, they wanted me to be the guy who replaced the person who was a first-time founder. I was the same guy, but now they had the validation that they couldn't somehow see with their own eyes, right? Like they saw me on the ground every day building the business, building intrinsic value, and they didn't have the confidence in that. But once the credential was there, they were like, oh, now that's an experienced founder. He got an 8X exit for me, and they kept showing me new companies they wanted me to lead and replace the founder. So that's a classic thing, right? It's happening maybe less, but even in terms of investing, there's a massive premium for repeat founders. What I'd say is there is no question repeat founders learn a lot, and there's also no question they overly rely on that experience in ways that don't necessarily translate to the next one. We have had mixed success. So I think in our view, it isn't like definitive that somehow a repeat founder is better than an existing founder. Although I will note, most of the largest wins we've had were from founders whose previous businesses had pretty small outcomes. So they were repeat founders, but not like notably at all repeat founders. They had learned a lot, but they certainly didn't have tremendous arrogance or hubris from the very modest to mixed even success they had in the last business. So Dave likes to call it like they learned on someone else's dime. But I think that's like a little too casual. Like I just feel like they really learned a lot and they struggled through a lot of stuff and they were able to utilize that very successfully the next time. But we've had great success with first-time founders as well.
Hi, you said that network access is a particularly important piece of getting a deck in front of you and your team, and that seems to be a common trend with a lot of VCs. Network access is commonly a gap for underrepresented founders, particularly those who are new. How do you think about that? You've had some awesome, refreshing perspectives, and I'm really curious about how you bridge that gap or you think about bridging it.
Yeah, I mean, this is what I told you. It's like one of the things that makes me most uncomfortable about the industry. And yet I haven't come up, given we're so heavily investing truly in people, I haven't come up with a great way to get around, somebody cold where we have no signal on them versus somebody saying, this is somebody I've worked with and deeply respect. It's night and day, right? And so what I would say is, if you're from an underrepresented group, and I want to say this with this is for everybody, but it's certainly very relevant to anyone from an underrepresented group. You got to do a great job building that tribe. You may want to think about, for example, here in Boston, we have Visible Hands. It is specifically an accelerator for underrepresented founders. We're very interested in the companies that they select and then say, hey, Eric, this is a really cool company you should be looking at. Well, all of a sudden, they might have had no network, and now they've got great network, right? And of course, it doesn't need to be Visible Hands. It could be Techstars. It could be, but you've got to work your way into communities that can start to help you build your tribe, right? And I think that's one of the biggest myths of entrepreneurship. There's so much celebrity, and in a way correctly, because it is such a challenging journey, but celebrity, sort of put upon the entrepreneur that it makes it seem like they did it all alone. And of course, not only do they have a management team, maybe investors, whatever, it takes a village. There was usually a tribe, right, of people. Many of them get no equity, don't do it, besides being, I think back, we were in the MIT 50K, and we went to the 1K Midnight Madness event that they did to prep. And two people we met at Midnight Madness, we stayed in touch with for years, and were just super helpful to us. And they made introductions, and they didn't have to do that. We never gave them equity in our startup because they were just casually trying to help us, but they were really helpful. And so it really does take a village, and And you can't think of it as like, I'm here on my own. You've got to find your way, whoever you are, you've got to find your way to building that community around you of people who will say, you know, I know this person, I really think highly of them. I'm excited to help them. Entrepreneurs are good at getting people excited to help them. That's a really important skill. If you are an entrepreneur and you have a great opportunity to serve a customer, but you're lousy at that, that is not a skill you are good at, you need a partner. You have to have somebody on your team who wants to do that work. There are a lot of people allergic to the idea of the business guy. And I think it's like, they think of it a little bit as like used car salesman, blah, blah, blah. The reality is Howard Stevenson from Harvard Business School had this amazing definition of entrepreneurship, which was being able to create something well beyond the resources within your control. I thought that was like a pretty extraordinary definition for a lot of reasons. The more you think about it, the more you're like, that's very interesting. There has to be somebody who wants to do that work, like wants to meet with person after person after person, knowing that most of the time they're going to get rejection, just trying to win people onto the mission, right? Somebody's got to want to do that work. There are very few startups you can kind of sit in your basement and hack away and like it doesn't matter whether you have anyone on your team who likes to do that work.
All right, so unfortunately we are just about at time, so we are going to close questions now. I'm sure you can try and catch them on the way out. But thank you so much for coming here and sharing your insights. A little round of applause is in order, I think.
Thanks.
I was gonna say my advice is to go follow Eric on Twitter because he is like just dropping these nuggets every, I don't know.
The election season has me pulling back a little bit, but I'm on Twitter and I do write a lot about entrepreneurship. But
Yeah. Thank you
Twitter's
so
become
much.
a mess. Anyway.
Thank you.
Our closing party is going to be tonight at 5 on the first floor if you would like to attend that. The next session here is going to be Getting Social, Thinking About Impact in Investing.